The financial world realized that Credit Suisse had lost 15% of its value and that the large Japanese bank Nomura had also lost 15%. At the origin of this stock market crisis, a hedge fund called Archegos was unable to meet its obligations. The two big banks therefore sold $20 billion worth of shares in a hurry to limit the catastrophe. In financial jargon, this is called a margin call. Basically, when you want to buy more stock than you have money available, you can borrow money from your bank. It is this leveraged position that forces the bank to ask you for collateral to ensure that the client will always be in a position to repay the loan. As the value of shares moves in the markets, the loan contract between the bank and the client always provides that the bank can instantly sell the shares held by the client if at any time he no longer presents sufficient guarantees. So how can we explain that two major banks worldwide are taking losses on a transaction of this kind that is still secure in theory? What is the collateral damage of a massive scale for $20 billion on only a few shares? Some even fear a Lehman moment, in memory of the failure of the Lehman Brothers Bank, which hammered the last nail in the start of the subprime crisis. Many questions, to which I bring you first, leads knowing that this story is perhaps only the beginning. Come on, let's go. How did this story start? You have to look at Viacom CBS, which is a video production company of which you certainly know some films or series since it owns hundreds of very famous titles. Since 1990, the company's value has risen from $5 to a high of $100 in March 2021. Yet as you can see, between 2017 and March 2020, the stock is losing momentum because Viacom CBS has not taken the step into streaming. Its productions are mostly broadcast via TV. The turbulence on Viacom CBS corresponds to the arrival of giants like Netflix. Realizing that this streaming revolution will not be circumvented, Viacom CBS is embarking on a major investment plan to adapt its business to the internet. Shortly after the announcement of a new online platform with its huge catalog, the stock railed from a low of $10 to a high of $100 on March 19, 2021. And then, aware that the share price is probably benefiting from a bubble in this sector, the management of Viacom CBS decides to issue $3 billion worth of new shares at $85, which is a very clever way to make the company benefit from a gigantic cash injection on the backs of traders. Of course, the share price goes down, but it doesn't just drop a little. It drops by half in a week. It's monstrous. But hey, at first it goes unnoticed because analysts from major institutions have issued valuations at around $50 a share. So why not? But then, at the end of March, we learn that other stocks have fallen. These companies have in common a Hong Kong-based investment fund, Archegos, which allegedly defaulted on a margin call. The company was highly leveraged to the upside, and when Viacom CBS turned around, it apparently was unable to bring in more cash to maintain its positions. In this case, as is expected in such situations, the bank proceeds to sell the securities to hedge its risk. So, until then, it is understandable why apparently unrelated stocks start to fall. However, what is hard to understand are the warnings on results issued by Credit Suisse and Nomura Bank. Nomura announces that all of its profits for the second half of the year will probably be lost in the operation, and Credit Suisse announces a high loss. It is rumored that the amount would be about $3 to $4 billion, or 1 to 2 years of the company's profits. The blow is severe. What we don't understand is the reason for these losses, since legally, any trading operation with leverage must be risk-free for the bank. Moreover, it is two large banks that have been caught. This suggests that the financial system is far from being as reliable as it claims. At the same time, it is not surprising because when you have to sell 20 billion shares on a few targeted stocks, you know that you're going to bring down the prices. But you still have to get out quickly because you know that if the news gets out, you will probably focus speculative downside attacks on the stocks you are selling and on your own company that is in trouble. you can see how quickly things can get out of control. For Credit Suisse, the timing is even worse because the Swiss bank is in the middle of the Greencell affair. Here again, all the problems come from a miscalculated risk and from events that will cost the bank's clients around $3 billion. Greencell was what we call a reverse invoicing company. Simply put, when you are a merchant, your customers and suppliers do not pay you at the same time. So if your customers owe you money from your sales 30 days after you have to pay your suppliers, you have a temporary cash flow problem. In this case, you can go to a factor who will buy the receivables your customer owes you. If your customer owes you $100, you sell the receivable for $95 to the factor, which allows you to pay your suppliers. On the other hand, the factor will collect $100 at the end of the month and will have earned $5. This is a very standard procedure. The problem is that Credit Suisse has transformed this commercial factoring service into a financial product that it has distributed to its clients. In March 2020, with the lockdown in Europe, many companies found themselves unable to pay their bills, and Greencell found itself bankrupt. Bad luck, you may say. This is one of the many consequences of the crisis of the anti-COVID measures. The problem is that the Credit Suisse operations that transformed these claims into financial products also allowed the consequences of this economic crisis to be transmitted into a financial crisis for the savers who bought the Credit Suisse financial products. They thought they were buying a very low-risk savings product, and they end up with $3 billion in losses. It stings. We don't know how far the damage to Greencell and Archegos will go, but what we do know is that our current financial system is terribly optimized and adapted for a low-risk world. Yes, in theory, in a very safe and growing world, these securitization or leverage strategies can make sparks fly in terms of earnings growth. However, like any optimized strategy, it is very fragile to shocks. What we call a Lehman moment is a crisis of a not very high intensity in itself, but which takes place at a point in the financial system that will generate chain reactions and ultimately block the entire system. And then a systemic crisis is triggered. A hedge fund that does not insure its margin calls? This could cost $10 billion. A big ship blocking the Suez Canal? That's about $10 billion a day in damage to world trade. Our economies are even connected by our movements. A big epidemic of COVID? It spreads across the planet and causes trillions in losses of all kinds. The substance of my message is as follows. Our over-optimized world does not tolerate too big and too brutal shakeups. Capitalism is very adaptable in itself because in the end, the resilience of the system depends on the initiatives of a multitude of people. On the other hand, the system can be profoundly disorganized by a grain of sand in the cogs with very heavy consequences. On that note, see you soon for new videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.